All right. Today is Sunday, September 12th. This is a recap for the stock market activities last week and an outlook for the week to come. Before we start, an important announcement regarding the future of this channel. I have been producing daily content that ranges from 40 minutes to an hour every single day. And I do that as a part-time job, by the way, on top of my regular job. So it has been exhausting, and the reality is producing an hour video that includes the technical analysis and the fundamental analysis together is not realistic, at least for now. And the reason is I've been doing this solo, from preparing the content to recording to editing to producing to uploading, only to be met with restrictions from YouTube regarding some bullshit copyright or unsuitable for ads, etc., and I have to upload again after deleting whatever they did not like. And by the way, they don't even tell you what the violation is. You have to guess. And by the time the videos come out, it's already 9 o'clock Pacific time, midnight or past midnight Eastern time. And this has cost the channel a lot of growth, a lot of potential growth. Number one, viewers in different time zones, let's say the East Coast, for example, when they get the content past midnight, the likelihood is they will watch it in the morning with limited time before the markets open, or perhaps even after the market already opened and now the content is already outdated and it means nothing at all, no value at all. Number two, the length of the videos being about 40 minutes minimum every day is perhaps too much for the average attention span that we have right now. We are the TikTok generation, the Reels generation. Our attention span is pretty much the attention span of a hummingbird. 5 minutes tops, and then we lose concentration without a hit of Adderall. You gotta grease up that Adderall over and over and over again. So 40 minutes a minimum is perhaps too much, and perhaps also cost us some growth in this channel. Now, in creating this channel, I did that in purpose. And the reason is I want the channel to be a home for seasoned, disciplined investors and traders, not the kind of traders and investors who are joining in a bubble market thinking that the market is a video game. You get in, you score high and fast, because this type of traders and investors will participate in the mania, but they will be flushed out of the market quickly. And when the market returns to normalcy, you will see these kind of traders and investors gone, completely disappeared from the market. So am I going to build a channel, a transitory channel, based on transitory investors and traders who are going to be there in the bubble, but then after that, they're not going to be here anymore? You might have noticed that views in financial channels in general in YouTube spiked up higher during the pandemic. And this is understandable because more retail traders and investors got involved in the stock market. But what will happen when we get back to normal? What does normal mean, by the way? It means going back to work, the market will crash, it will normalize, it will become a boring market once again, and you're going to see the majority of these retail investors and traders who got engaged in the market during the pandemic moving on, and therefore intentionally in designing this channel, making videos 40 minutes a minimum, not pumping popular stocks, meme stocks, and talking about garbage, but actually talking about the reality of the market, the reality of the bubble, the reality of the economy, and the reality of technical analysis. By doing so, I made the channel unattractive for that type of investors. And of course, therefore, this channel is growing at a slower pace than other channels. But we have a dilemma here, which is me going back to the office. It was supposed to be in September. Now it's delayed to November due to Delta, so perhaps you should be cheering Delta, 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 because next thing you know, we're going to delay this all the way till the next year, 2022. In any case, I want to try my best to maintain the design of the channel of attracting serious investors and traders and those who aspire to be serious investors and traders at some point, and avoid attracting the garbage, while also maximizing the growth potential. Because at some point I'm going to have to sit down and make a decision. Do I continue with this channel or do I move on? And at that point, in making that decision, I want the channel to have achieved perhaps the maximum growth potential that it has during that period of time. And therefore, I'm going to go back to the same experiment that I have done before, which is splitting the videos into 2 videos daily. One video comes out earlier in the day, meaning before 6 o'clock Pacific time, 9 o'clock Eastern time. And this video will be the technical analysis and the market information. And then a later video in the evening, which will include my market commentary, the macro analysis, and the headlines of the day. So 2 videos per day. One will be the technical analysis. The second will be the headlines of the day, aka the fundamentals analysis. My preference, of course, is one long video because, as I've taught you before, technical analysis is extremely limited when it's not combined with the fundamentals. You could get lost following the technicals alone. But unfortunately, I'm out of options here. I did try this experiment before, and it did fail. I split the videos into 2. But what I noticed is a cannibalization effect where people watch the newest release and not watch the earlier release. And you have other viewers confused. Where is the technical analysis? Where is the fundamental analysis? Where is the headlines of the day? So I'm going to try again, and this time around, I will give you clear guidelines on how to distinguish between the different videos. The technical analysis videos, which should come out earlier in the day, will have the icon of the candlesticks. On the other hand, the fundamental analysis, the headlines of the day, will have the planet icon. And this is how you'll be able to distinguish between the technical analysis video and the fundamental / headlines of the day video. I hope this will work. We'll see what happens. I'll do a week starting today, and we'll see how I and you like it. And if we don't, we're just going to go back to what we've been doing before. But I have listened to your complaints, specifically East Coasters, and I am initiating my accommodation policy to you, where the technical analysis, the time-sensitive data, comes out earlier, so you can catch up with that. And then no pressure when it comes to the fundamental analysis and the headlines of the day. You're not going to miss out anything. You can watch them in the morning, you can watch them the next day, you can watch them whenever you like. Anyhow, this is the announcement. Let me know what you think in the comments. I'm going to look at it, consider it, and then I'm going to do what I was going to do anyways. Now, let's comment on the market quickly before we start with the market information. The market on Friday opened higher, and the reason is we got the call between Biden and Xi, and the market had that optimism that perhaps we're about to have a better relationship between the United States and China. And therefore, let's pump stocks higher because a significant worry in the wall of worry was China. China been cracking down on everything. And the next shoe to drop was, perhaps still is, when will China start cracking down against US-based companies, meaning Apple, Starbucks, Nike, etc.? Because when that happens, you will see a crash like you have never seen before. Because the majority of these companies are dependent on the country of China for their growth. You look at Apple, for example, the company's not growing in North America. The company's not growing in Europe, not anything significant to say the least. But the majority of growth comes out of the Chinese market, and therefore any crackdown from Xi against US companies will be extremely painful. Therefore, the assumption that the call between Biden and Xi perhaps will calm down those fears that China will crack down on American companies. But rest assured, the call was a bust. We still have disagreements, and the likelihood is that the relationship between China and the United States will sour in the next few months as China continues with its programs and initiatives of common prosperity and the nationalist agenda, which perhaps include at some point an invasion of Taiwan. So the market starts up higher based on the US-China relationship optimism, but it sells off anyways. And that leads me to the next point. There is a significant change in the market. Just a few weeks ago, every dip was bought in the market. Aggressively so. Every single dip was thought as a buying opportunity. The last few days, every single rip was sold and was looked at as a profit-taking opportunity and a shorting opportunity. And this is an important change in sentiment in the market. When buy the dip becomes sell the rip, we got a problem here. And I shared with you the anecdotal evidence from my own experience that my clients, of course, in my personal portfolio, I already shared that on Twitter, by the way. I told you I'm liquidating 70 to 80% of positions in my portfolio. This was back in August when the market was trading higher and higher and higher. A lot of clients thought, why would we take profits right now? The dips are being bought. The Fed is not going to taper. The sentiment is good. The earnings revisions are going higher, which is the biggest piece of crap garbage I've ever heard. But they continue to repeat that on CNBC over and over and over again. Earnings revisions higher. The does that even mean? Some analyst made a guesstimate that the earnings are going to be whatever number, and now they're revising it higher. Who cares? These analysts are wrong most of the time. But again, that deceives clients, regular investors, mom and pops, into thinking, wow, the analysts know something here. The analysts are revising earnings higher. Who cares? So anyhow, the sentiment back in August was, we're not selling, we're not hedging even. The market is going to go higher with no stop in sight. Now that we are already into September, the seasonality plus the taper fear, inflation continues to rise higher, Delta is becoming a problem. A lot of companies are coming out and saying, hey, with this inflation and cost burdens, we're actually revising our earnings down, unlike the genius analysts. And all of a sudden, all of these clients, all of these mom and pop investors are rushing to hedge their portfolios. Can you hedge my portfolio, please? What should I do? And perhaps that leads me to the comment or the question from the viewer asking to make a video about hedging. We've already made that, by the way. Perhaps you want to look at the video. I don't know if that's going to be helpful or not, but if it's not, I can help you one-to-one in the comments. Let me know your situation. I'll try to figure out a hedging strategy for you. But in a nutshell, you have three options here. Number one, you take profits. Old school, your stock is up 70, 80% within a few months. That's insane. You take profits and you move on. If you can't take profits for taxation reasons or whatever, you can sell calls to raise capital. The risk, of course, if your stock shoots up higher, you're going to have to sell your stock at the strike price. The other strategy is buying puts. That's what puts are made for. Insurance, protection. You buy puts, you figure out your risk tolerance. What is your risk tolerance? How much are you willing to lose? You set up that floor, you buy the put option, and any losses beyond that point will be compensated for. That is your insurance policy. Another important development on Friday is, you guessed it, Apple. Apple crashed. And we will talk in the headlines of the day video, which should come out later this evening. We will talk about the PPI, we will talk about Apple, and we will talk about the role of organized crime in raising inflation higher. But from a technical perspective, in a psychological perspective, we had important developments here. Number one, Crush the VIX Friday was defeated. Every Friday, the VIX gets sold off. This time around, the VIX was bought, and the VIX closed the week above 20, which is a massive win for the bears in this market. Number two, we have big tech stocks getting shot, specifically Apple, which is the most important stock in the market. If Apple goes down, everything will go down with it. Due to the ETFization of the market, the weighting of Apple is extremely dangerous when it gets sold off. It takes down everything with it. Number three, cryptos were down on Friday, but still stable. So you gotta watch out for cryptos here, because a legitimate sell-off, a legitimate top in the market where the dip buying mentality is defeated will happen when the sentiment among retail traders and investors is crushed. And that will be evident by a sell-off in cryptos and also meme stocks. So if the market goes down, but meme stocks and cryptos are trading higher, then you have to assume that the sell-off in the market is transitory and the dips will be bought. And the reason is the retail crowd remains positive, evident by the performance of meme stocks and cryptos. But if the market goes down, along with cryptos and meme stocks, then we get a major problem here. And this will be more than just a pullback, more than just a correction. And of course, the last comment is, what a timing, huh? For Kaplan and Rosengren to liquidate their portfolios right at the top, right before the Fed starts to taper. Is this a coincidence or what? Anyhow, we're moving on to the market's performance on Friday. And here we go. The Dow Industrial Average closing in the red, down 271.66 points, or a decline of 0.78%. The Nasdaq down by 132.76 points, or a decline of 0.87%. The S&P 500 closing in the red, down 34.70 points, or a decline of 0.77%. What about the sector's performance on Friday? The only sector closing in the green is energy, but with a pathetic performance, barely in the green, and pretty much every other sector of the market closing in the red with severe losses. So we're not going to give any medals away, and the losers on Friday were led by REITs, utilities, and communication services. This is yet another, by the way, another ominous signal when the defensives are sold along with the offensives. Because usually when utilities and REITs pull back and we see tech and growth, for example, shooting up higher, this is an indicator that the market is bullish because we're moving away from defensives and yield proxies to offensive sectors of the market in the case of tech and growth that offer no yield at all. But when you have the defensives being sold off along with the offensives, be it the inflation trade, the cyclical trade of energy, financials, industrials, etc., along with the tech and growth names, we got a problem here. We got somewhat of a panicky sentiment in the market. What about the weekly performance? Every sector of the market, every single one, closed in the red for the week. But the majority of the pain was in REITs, followed by industrials, and then healthcare. Again, even these sectors of the market, which were thought of as defensives and safe, are now being shot to. Again, we get a bigger problem here. What about the advance to decline ratio on Friday? The NYSE, 28% advancing versus 69% declining. The NASDAQ, 31% advancing versus 64% declining. Awful breadth, awful advance to decline ratio. Usually, when we get this low in the advance to decline ratio, usually, not always, it is a sign of a short-term bottom, meaning we see a bounce in the market, but as evident by other elements that we will cover in this show, the likelihood is it will be a dead cat bounce and we will resume the sell-off right away. Futures, what's going on here? We had sizable gains in crude oil futures, whether we're talking about the WTI or Brent, both closing the day with over 2% gains. And again, as you're going to see in the PPI report, energy prices is a major burden on producers. Companies' earnings calls saying the same thing. These energy prices, gasoline prices are killing us. What do you think will happen when you have a company like PepsiCo, for example, paying more for gas, for trucking, wages, for the labor driving the truck? All of that cost will be passed down to you and I, the end customer. But somehow the Fed says this is transitory. Mr. Powell, you've been saying transitory for months and months and months. Energy prices continue to go higher and higher and higher. The dips are being bought in energy over and over and over again. Not just in energy, by the way, but also in commodities, copper, grains, meats. All of these dips are being bought because we have traders and investors in the market assuming that so long as the Fed continues to print, inflation will continue to rise higher. And inflation is good for commodities. Now, we have another story in natural gas, and you're going to hear it over and over again in the PPI report. Every single producer mentioned the inflation in natural gas prices as problematic. We're now inching at $5 in natural gas, which is a lot, by the way. Now, from a technical standpoint, I believe that nat gas have topped for now, and therefore I shorted natural gas on Friday. I'm not calling a top here, but I'm calling for a pullback because this is close to the prior highs that we have seen back in 2019. I'm expecting a pullback and then a resumption of the rally higher, so long as the Fed continues to print money out of thin air. And by the way, Hurricane Ida did significant damage here, and it will take a lot of time for the pipelines and infrastructure to be restored completely. On top of that, we're getting closer to the winter season, where the demand on natural gas will skyrocket naturally. Combine that with the scarcity of supply, and you have an excellent combination for natural gas prices to continue to rise higher. What about softs? We have losses led by cocoa and sugar. Meanwhile, gains led by OJ, lumber, watch out for that one, lumber, and coffee futures, while cotton futures closing in the flat line. What about metals? Losses for platinum, silver, gold, palladium, all closing in the red. And of course, palladium suffered significant losses in the last few days. We have news here related to the auto industry, and this will perhaps affect platinum prices, by the way. The shortage in chips is delaying production of cars. You might have heard the news from Toyota on Friday. Toyota said, we're extending the reduction of output longer. We're not going to be able to produce cars anymore because we don't have the chips to produce them. And if the production of cars is halted, then there is no need to buy palladium and platinum to produce catalytic converters. And therefore, we're seeing a crash here in both palladium and platinum. What's working for now is copper. The demand in copper remains hot, and it will not stop. Every dip is worthy of buying in copper until and unless the Fed starts tapering. And even then, the tailwinds for copper to go higher remain intact. What about meats? Massive losses for lean hogs futures, down over 3% on Friday. We have losses of about 1% for feeder cattle futures. Meanwhile, live cattle futures on the flat line. What about grains? We have gains across the board. Soybean meal, corn, rough rice, oats, canola, all trading higher. Meanwhile, we have modest losses for wheat and soybean oil. Now, we have news regarding corn, and I called the top in corn a few months ago. Corn was the number one trade for me starting in November, the Biden election. But as we got to May and June, it became more evident that the Chinese will plant more corn than ever before, and this will compensate for the reduction of output from the United States. Now, corn crops in the U.S. came out better than earlier expectations. Due to the drought and the heat, everybody thought that the output of corn this season will be bad. But on the contrary, it came out better than expectations, specifically out of Minnesota. For example, when we look at the forecast for the cash index, for different corn yields, you can see that the forecast of output pretty much across the board, but specifically in Minnesota, moved up a lot higher. So we will have better yield than we thought before. And therefore, I told you I'm shifting from corn to oils and oats. Continue to hold oats and move from corn to oils. Be it canola, be it soybean oil, all of these oils are shooting up higher in price. Moving on to the big casino, the options market. What's going on here? On Friday, the leader of the market was obviously Apple, with about 2.5 million contracts exchanging hands on Friday alone. About 63% of those were calls. Now, last time around, we saw 79% calls, and I told you that this is a sign for a top on Apple. When traders go bananas buying calls to extremes, it is usually a sign that the party is over. And at number 2, Tesla, with about 760,000 contracts, about 46% of those were calls. And at number 3, AMC, with about 600,000 contracts, about 69% of those were calls. We have a new name here, the ticker CCG. This is a new meme stock. It's not actually new. It's been pumped before. But now they're migrating from BBIG, SPRT. These names are already elevated. The premiums are too expensive. So the Wall Street bettors and the likes, they look for other names. And they found CCG for now. For example, when you look at the IV rank, CCIG at about 21%, BBIG at 70%, SPRT is 61%. The higher the IV rank, the higher the premiums, which make it less and less attractive to buy options on stocks with a higher IV rank. The opportunity is in a stock with a low IV rank. So are you looking at Palantir, PLTR? And while we're at it, by the way, let's move on to the implied volatility and let's see what's going on here. I'm looking at the IV percentage, by the way. Now, what does that mean? It means the number of days the implied volatility for this stock was trading below the current volatility within 1 year frame. For example, in Apple, it says 30%, which means the implied volatility of Apple going back for 1 year time frame. The implied volatility in Apple traded 30% of the time below the current reading. So is this a lot? Is this a little? It's not a lot because only 30% of days were below the implied volatility that we're reading right now. But it also means that the implied volatility is rising because historically speaking, you see Apple trading at an IV percentage of about 5%, 10%, 15%. 30, it means that Apple moved from 15% to 30%, meaning that the premiums of these options are rising in value. What does that mean for us traders? It means there is an opportunity of trading Apple's options. The opportunity is to catch the stock while the implied volatility is low, relatively speaking, and then riding the surge higher. What you don't want to do is getting engaged in an options trade when the implied volatility is historically high, and then you ride the wave to the downside and you see those premiums losing value even though the stock is perhaps moving in the right direction. You bought calls, the stock moves higher slightly, but you're still losing money. Why? Because the implied volatility is dropping. Now, take a look at Palantir, for example. The IV percentage is 1%, so only 1% of days, going back to 1 year time frame, only 1% of days, the implied volatility traded below this current implied volatility reading in Palantir. What does that mean? It means that we have bottomed in the implied volatility in Palantir. Now, does that mean that the stock is going to go higher, is going to go lower? It doesn't tell you any of that. All what the implied volatility says is perhaps there is an opportunity here to make your bets when it comes to Palantir, up or down. For example, let's say the market will crash next week. The whole market is going to crash. Every single stock you see right now in this list will crash. It'll be down 5, 7, 6%. Which options do you want to trade? Which options, which puts do you want to own on that downside? Do you want to own puts in Venco Ventures, BBIG, where the IV percentage is 93%, meaning that going back to 1 year time frame, 93% of times, 93%, the implied volatility traded below the current implied volatility in BBIG. What does that mean? Perhaps the implied volatility is topping in BBIG, and if you buy those premiums right now, even if you buy puts, for example, they're not going to produce awesome results, even if the stock crashes. Why? Because you bought at the top of the implied volatility. And as the stock goes down, the implied volatility is going down, and your premiums are losing value. I hope that this makes sense, by the way, and it's not confusing at all. But if it is, ask questions in the comments and I'll try to answer them. The bottom line is, you want to ride the wave higher when it comes to implied volatility. You don't want to ride the wave down. So you want to look for options on stocks where the implied volatility is rising higher, but still has a lot of room to continue to rise. And you want to avoid stocks with elevated implied volatility, perhaps stopping implied volatility, which is about to drop because you're going to pay more for these premiums, you're going to overpay, and even if the stock goes to the direction that you bet on, you might be losing money in the trade due to the reduction of implied volatility, which reduces options premiums. Moving on to the unusual activities that took place in the options market on Friday. Now, usually on Friday, we don't get a lot of unusual activities. Why? Because traders are not making bets on Friday, waiting for the decay in those options premiums. So we have a few trades here to cover. And we will start with the ticker that we just talked about, CCG. They're buying calls here, betting for more gains to come by buying the 27 calls with the expiration date of October 15th, with the expectations that the name will rise higher by more than 10.5% by then. And they paid about $1.20 a piece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker KWEB? This is the Chinese technology ETF, including Alibaba, etc. It's been getting crushed over and over and over again as we get more news pretty much every single day right now about the CCP cracking down on technology companies. But perhaps somebody's betting for a bottom here, specifically after the call between Biden and Xi, and they're buying calls for the KWEB, specifically the 56.5 calls with the expiration date of September 24th, with the expectations that the name will rise higher by more than 9% by then. They paid about 45 cents a piece, all in all, spending about $700,000 for this trade. And then we have the IYR. This is the real estate ETF. REITs been outperforming for weeks now as the market shifted toward the defensive tone. But perhaps the market is shifting from the defensive tone to the panic tone, which we drop everything pretty much down, including REITs. And REITs were down big this week, and somebody's betting for more declines to come. They bought the 101 puts, expiration date October 15th, with the expectations that the IYR will drop by more than 5.5% by then. They paid about 80 cents a piece to enter this trade. All in all, spending about $500,000. Lastly, what about the trade for the ticker AFRM? This is for Affirm. Now, you know the story. The moment Amazon announced that they will partner with Affirm for the buy now, pay later, or pay never platform, Affirm shares skyrocketed higher. A massive pop, and you're going to see a massive short squeeze here. We're at about 8 to 7% short float here, so we have more room to go in the short squeeze. And the likelihood is shorts will continue to cover. Why? Because this is a game changer. It will shoot up the revenue of Affirm 5-folds minimum, and therefore you don't want to short this name because you're standing against a storm, a tsunami of short covering. But in the meantime, we have seen a reduction in the open interest for calls on a firm, specifically in the upcoming monthly expiration of September, meaning this upcoming week. A reduction in open interest in the options market indicate closing those positions, meaning those who are long betting for gains on AFRM, a firm betting for the short squeeze, already made their profits and closed the trade. What does that mean? It opens the stock for a pullback, and of course that comes hand in hand with an opportunity to buy some puts. The problem is, even if the stock pulls back, the dip will be bought. Number one, these put options are betting for a pullback, not a sustainable loss here for the name, and therefore these put options traders will close quickly. On top of that, the dips will be bought by shorts covering their positions, and they will continue to cover because this is a game changer. But here we have the put trade. They're buying the 110 puts with the expiration date of September 17th, meaning this upcoming week, with the expectations that a firm will pull down by about 11% or more, and they paid about $1.50 a piece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis. What's going on here? This is a weekly heat map, by the way, and obviously losses across the board. The majority of the market was trading down. We're seeing massive pain in the healthcare sector specifically, and this is likely to continue if market participants are liquidating their positions out of the market, because when we look at the 100 days moving average across different sectors of the market, the likelihood is the sell-off will come from sectors that are outperforming in the market. When we look at financials, healthcare, REITs, utilities, they're trading way above the 100 days moving average. When we look at REITs, for example, 86% above the 100 days moving average. Utilities, 82% above the 100 days moving average. Likewise, healthcare also trading about 72% above the 100 days moving average. So in the event of liquidation out of the market, these sectors will be hit the most. The sectors that have been outperforming for a while. We're talking about financials, healthcare, REITs, and utilities. Now, when it comes to financials, it depends, because if algos are taking control, algos will trade financials based on the move in the bond market. If yields go higher, algos will push financials higher. But if the human being is involved, and we have a panic liquidation event in the market, then financials will be sold regardless of how yields are trading. Now, when we talk about Apple's woes, the decision out of the court to allow apps to bypass the App Store policy of providing alternatives for customers to pay, so the iMob doesn't get the 30% cut. Apple was down, but from a weekly perspective, and it was more evident on Friday, you look at names like Match.com, the ticker MTCH, DoorDash, even Airbnb, the ticker ABNB, all trading higher for the week, specifically on Friday, because they don't have to pay the iMob 30% anymore. Likewise, when we look at video games companies like Roblox, Electronic Arts, all trading higher on Friday. And those gains on Friday helped some names to close the week in the green. We also have the ticker LCID, Lucid. This is not related to Apple, by the way, but it is related to the infrastructure, not the infrastructure, the structure of SPACs, aka scams. At some point, you're going to have the redemption where you have to buy the stock, and we're seeing some of these redemptions happening by selling other stocks and buying Lucid shares, and therefore Lucid trading higher and defying the overall market. Likewise, we have Peloton, PTON, closing the week with gains of over 13%. Now, they say that these gains are due to Peloton announcing apparel merchandise. I doubt it. I think somebody big bought the name, perhaps Kathy Wood added to Peloton. We know she likes to hold the bag. And then we have Lulu, a more legitimate apparel merchandise company, also closing in the green, defying the market, and this is on the heels of earnings, by the way. And then we have the ticker KMX, CarMax. This is a stock that I own in my portfolio, also rising higher because we heard from multiple car manufacturers, General Motors, Toyota, all saying we will delay our production further than we have expected before. And the reason is the chip shortage continues to get worse and worse and worse. And therefore, consumers have no choice but to buy used cars. And these used cars will happen to be bought from CarMax, because CarMax made an intelligent decision last year. When car prices were down the toilet, they hoarded all of these used cars. They bought them, and now as prices of used cars continue to surge higher, they get to sell these cars with an impressive margin. Another outperformer Defying the market's trend is the semiconductor sector, which we just talked about, but specifically the ticker ADI analog devices, closing the week in the green by about 4.5%. What about the losers? We talked about Apple, but take a look at the technology sector in general. The software and these momentum names, Square, Okta, Robinhood, Path, Coinbase, DocuSign, TTD, Trade Desk, all with massive losses. And this is yet another evidence that the sentiment in the market is being shot. Likewise, we saw losses in home builders, Lennar, D.R. Horton. Ugly week, absolutely brutal. Perhaps this is a sign that yields are about to rise higher, interest rates are about to rise higher, and the Fed tapers, and this will crash the housing market, and all of these home builders will also crash. Lastly, what about the weekly ETF map? Pretty much everything closing the week with losses beside the inverse ETFs that you buy when the market goes down. We're talking about the SDOW, betting against the Dow, the SQQs betting against the Qs, the SPXS betting against the SPY, the TZA betting against the IWM, and of course we have the VIX proxies, the VXX, the UVXY, all closing the week in the green. Even in international ETFs, the picture was overall negative, with exception of the Japanese ETF, the ticker EWJ traded higher for the week was the exception worldwide. And the reason is we have the resignation of Prime Minister Suga, and the market celebrated on the basis that perhaps a new administration will be more friendly to the market than the Tsuga administration. Moving on to the charts, starting with the SPY 30 minutes chart, and let's see what happened here. The damages. We talked about the line in the sand, as you can see in yellow, which was the previous day's lows. If that was violated, I told you that the floodgates will open. And indeed, the line was broken. The chart attempted to reclimb the line, but it was met with failure and a rejection. And that was it right there. If you are a trader and you're looking for signs, that rejection was goodnight Irene. The market will flush down. And indeed it did. After the rejection, the market flushed down, not even stopping at 447. And it is eyeing a support level. It is eyeing a bottom at some point. Could it be 443? Now, you have to combine the candlestick patterns with the RSI. Where is the RSI trading, by the way? It is trading at a buy zone. What does that mean? It means that it won't be unusual for the market to rebound higher, to bounce on Monday. But here's the catch. If you are a bear betting for the market to go down, the ideal scenario for you would be the market rebounding higher, working off the oversold conditions in the RSI, and that bounce would be a dead cat bounce, a trap, and then the market flushes down, because it will be yet another confirmation that the market is struggling to move higher, and we have moved from buy the dip to sell the rip, and it will give bears another opportunity to short the market and hop in the short side. The worst case scenario for the bears is for the market to open gapping down severely. Let's say at 443, perhaps all the way down to 438. And then we see significant buying of the dip with higher volume, and the market closes at the highs of the day, because that would be a bottom and the shorting opportunity is gone. Moving on to the daily chart for the continuous contract on the SPY. We have a trend line, and the market is pulling down back to the trend line in a normal garden variety pullback, which should produce about 3% correction. Now, you can trace it with a trend line. Other people will trace it via the moving average. You can do either. Doesn't matter to me. I'm not a fan of moving averages. I use trend lines. Now, the likelihood is, looking at the volume and the collapse of momentum from the MACD and RSI indicators, the likelihood is the correction will go below and will pierce the trend line. So we have to look for 4,384.5. This will be the line in the sand. If the market closes the week below that number, then we have significant pain to come. And this is not just a correction. It's not just a pullback. It is more than that. The Qs, 30 minutes chart. What's going on here? Again, violating the support of 378.45, but you have to pay attention to the RSI. The RSI is at oversold conditions, aka the buy zone, aka the rebound zone, so it wouldn't be unusual for the market to open up higher, rebounding higher on Monday. But the real test will be if the market rebounds higher. Will we see sell the rip once again? And if that happens, then the bears have a confirmation. And it will be bear porn at that point. Or shall we say, to keep it PG-13, music to the ears of bears? Because you combine the change in sentiment from buy the dip to sell the rip, on top of that the seasonality in September, and you have a great chance that the market will flush down more than 5%. This is the continuous contract, the daily chart on the Nasdaq. Again, the momentum indicators, the MACD and the RSI are curling down, meaning that they have already topped. But when you look at the volume for the continuous contract on the Nasdaq, and you contrast that with the continuous contract on the SPY, the volume did not rise significantly higher in the Nasdaq. But we have the big kahuna Apple being shot. You're going to see a lot of propagandists coming out on Monday, from Katie Huberty to the Thupathakal Don Ives and many others, coming out on Monday defending Apple through and through. The Thupathakal, the greatest stock ever, the dip is worthy of buying. Why? Because they're propagandists. And Apple is the largest holding among institutionals. They're not going to allow that name to go down. And if it goes down, it's game over. Of course, we're going to talk about Apple in details in the headlines of the day video and why the court's ruling is indeed a game changer for Apple and app developers, by the way. NDX daily chart, what's going on here? If we pull back to the trend line, in the Nasdaq, it's going to be a bigger correction, a more severe one than the SPY. It will be to the tune of about 10% correction in the Nasdaq. And if I'm reading the market correctly, let's say the SPY and the Nasdaq move down to the trend line and perhaps pierce those trend lines by a little bit. In the SPY's case, the correction will be 3 to 5%. In the Nasdaq, it will be closer to 10%. What does that mean? It means that perhaps some of the inflationary sectors of the market will hold up a little better. Perhaps some defensives might hold up a little better, even though we're seeing weakness in the defensive sectors of the market, including REITs, utilities, and healthcare. What about the IWM 30 minutes chart? Again, violating the support line of 223 now becomes resistance, and the support moves down to 218. In a panic situation, everything will be sold off, and it appears to me that the market is heading to the panic situation, to the panic scenario. This is at least my reading of the sentiment from my anecdotal evidence from my own experience. I'm seeing talk along the lines that inflation is getting out of hand, and finally they're succumbing to the view that the Fed will indeed taper because they have no other choice. Raising interest rates will be disastrous. To avoid that scenario, the Fed must start tapering now. Yes, it will crash the market. It will perhaps crash the real estate market, but the market could rebound again due to the fiscal spending and the accommodative policy of lower interest rates. But if the Fed waits and waits and waits, then we will get to the scenario that tapering is not enough alone. You're going to have to accompany that with raising interest rates, and that will be beyond game over. The Dixie, what's going on here? We have the double bottom, the support at 92, and it looks to me that the Dixie wants to move higher, significantly higher, and it has a lot of tailwinds here to continue to move higher, not just from tapering, but the sell-off and the appetite of overseas investors to buy the US dollar. What does that mean for gold? The daily chart, we have a triple rejection from the Fibonacci resistance level, and we're looking for the Fibonacci support at 1,750 almost. Gold could pull down all the way there, and then we'll take it from that point. What about yields? What's going on here? The 10-year yield, the 1.28 support line looks like it is solid for now. It has been retested over and over and over again, and the likelihood is yields should move higher. Now, in a panic sell-off, it's really tricky here, because in a sell-off, there's a panic and investors rush to buy bonds, pushing yields down. On the other hand, the reason for the sell-off is perhaps inflation getting out of hand, and the Fed has to taper, which should take yields higher. So it's really tricky to read how yields will react right now if we head into a panic sell-off in the market. But all in all, when we zoom out to the weekly chart, when you look at the momentum indicators, for example, the MACD, it is curling upward. It cooled off from elevated levels, and it looks like bond yields are recharging for another rally higher. You have a lot of seasoned investors, including Bill Gross, the Bond King, and even Michael Burry, the Big Short, all betting that yields will skyrocket higher, and I have no reason at all to doubt their conviction. What about the TLT weekly chart? What's going on here? Still hugging 149, yet closing the week below 149. Is it by much? Is it significant? Not at all. The battle in the bond market continues, and the winner will not be evident. The smoke will not settle. The dust will not settle until the Fed finally announces tapering. And when that happens, we know what will happen. Yields will go higher, bonds will go down because the sugar daddy will cease to buy bonds. So even if you're betting for the TLT to go higher, it could go higher in the short term, but in the long term, sooner or later, bonds will go down. The super cycle in bonds is over. It has been going on for over a decade now. It's time for it to stop, specifically when inflation entered the chat. Moving on to the VIX, what's going on here? 4 hours chart. Look at the MACD indicator. Accurate, spot on, 100%. Not a single pop was misleading here. Every single pop in the MACD indicator was met by a double-digit gain minimum in the VIX and declines, pullbacks in the SPY. This one is more significant because the VIX closed the week, closing Friday above 20, and it looks like the MACD indicator from 4 hours perspective still has plenty of room to go. And again, if that's the case, the VIX blasting higher and the market opening up, gapping down, which will be the worst scenario for bears, by the way, because if you have not shorted before, well, you lost the opportunity. And the likelihood is, if we have a massive gap down, the buy the dip mentality is weakened but not defeated. The bears are fighting significant power dynamics here that have been going on for a long time. Buy the dip, the support of the Fed, the sentiment being extremely bullish, the cash on the sideline. There are a lot of arguments here, bullish arguments, valid arguments for the market to continue to go higher. So the bears are fighting from a disadvantage. They have gained significant advantage, made significant progress last week, but it's still, when it comes to the power dynamics, who has the upper hand? The bulls still have the upper hand in this market. But this upcoming week will confirm the advantage. If the market closes the week down, then we have a confirmation the bears won and the bears are now stealing the momentum, and we will see significant losses across the indices. However, if the market rebounds, closing the week in the green, significantly so, then buy the dip hasn't been defeated yet. I see that difficult to believe when you have Apple trading down, the VIX closing the week above 20, but perhaps the ultimate confirmation will be the weakness in meme stocks and cryptos, because these two indicators will be extremely important regarding the sentiment from the retail side, who've been buying the dip aggressively so. For now, looking at the VIX, the pop is not over. What about Apple? What's going on here? This is a 30 minutes chart, by the way. And finally, Apple flushing down and breaking the support of 150. And the likelihood is we will see more pain to come here. We could see a bounce on Monday, but yet another rejection from 150 will be confirmation and an opportunity for bears to short Apple, who missed on shorting Apple at the top. You can short it after a rejection once again from 150. And the likelihood is the chart will flush down all the way to the support of 145. We have a head and shoulder formation, and it is playing out to the downside. The technicals and the fundamentals are all aligning in favor of bears, which is bad news for Apple and for the market. And by the way, this is what I said about Apple a few weeks ago. Every time the stock traded in these levels, from an RSI perspective, a massive correction, a sizable correction followed the movement of the stock. So here's what I'm saying. If the stock blasts all the way to reach the top of the channel, I will be shorting Apple with both hands. And indeed, here's the daily chart. We're now at the upper limit of the range and the chart is pulling back. Now I'd like to switch to the weekly chart so we can see it clearly. When we look at the weekly chart, Apple is trading at the upper band, the resistance band, and it's pulling back. And we have weakness in the RSI and the MACD momentum indicator. Therefore, the expectations are we could see a nasty pullback here in Apple all the way down to the lower band of support, which will be around 135, 138. Again, in the grand scheme of things, not a big correction at all, not a crash, not a panic situation, just normal market behavior. The market doesn't go up in a straight line, folks. You're going to have corrections. You're going to have pullbacks. And we're watching and eyeing if this correction and pullback will morph into something bigger, like a crash, for example. Tesla, what's going on here? We have a severe pullback here along with the market. Tesla is not defying the market's trend, at least on Friday. But is the overall trend in Tesla intact? Yes, it is. Higher highs, and higher lows. I said on Friday, not on Friday, but on Thursday, I said the bears have to wait till the trend of higher highs and higher lows is violated, meaning Apple closing below 720. However, I did not listen to myself. I did not wait, and I started shorting Tesla on Friday. And I issued the tweet right away. I'm buying souffle puts. I think it will weaken next week. And indeed, from that point on, Tesla flushed down, and the likelihood is we will see more pain to come for the souffle. So why did I jump the gun and not waited for the trend of higher highs and higher lows to be violated first? The reason behind that is the action that I saw in the options market. For example, these options are for the expiration date of this upcoming week, the monthly expiration September 17th. Look at the open interest and the volume for the calls. Dry, nothing going on, weak volume, weak open interest for souffle calls. But when we look at souffle puts, specifically the 700 puts, massive surge in volume. Over 40, almost 43,000 contracts for the 700 puts traded hands on Friday. And the open interest also surged higher. Now, what does that mean? It means that options traders have high conviction at this point that Tesla will trade down and it will violate the 700 support line. So I'm going on with the conviction here, initiating the trade, and I will add more to it if Tesla indeed breaks the pattern of higher highs and higher lows. Tulips, what's going on with BTC? Nothing at all. Consolidating, absorbing the shock, but so far so good because we have not seen the second leg down in BTC. Usually you get a slap in the face and then you wait a little bit and the next shoe drops. For now, the next shoe did not drop, but in my opinion it will. Just give it time. I'm watching BTC and cryptos in general. Why? Because I need a confirmation here that the dip buying mentality is over. It's crushed, it is defeated, and it's gone. This will not be confirmed without weakness, significant weakness in cryptos and meme stocks. And my target here when it comes to BTC is 42,000. I want to see how it performs at 42,000. What about the meme stock, AMC? This is the most important name right now in meme stocks. Forget about GME, forget about SPRT, forget about BBIG. All of these are pumps and dumps. AMC has the perhaps more legitimate movement behind it from the retail traders and investors community. They bought it and they're still hodling. When will this sentiment be defeated? Well, looking at the chart, not going to be anytime soon because the chart traded all the way extremely close to 52. And now it is consolidating in a bull flag formation, perhaps to pop higher above 52. It has been a consistent pattern. When the market sells off, meme stocks outperform. If the sell-off in the market continues, let's say Apple opens down, Amazon, the industrials, financials, all opening down on Monday, but magically AMC is trading higher, and be careful because the buy the dip mentality is not over yet. The sentiment in retail traders and investors is not shaken out yet, so long as meme stocks continue to outperform. The moment cryptos and meme stocks start to crash down 10, 15%, and the dip buyers get smoked every time they buy, then we're talking. And therefore, I'm watching AMC and cryptos extremely closely. 52 is the number to watch. And here is the last chart of the day that I want to share with you. It is the contrast of performance between the XME, the materials ETF, the XLK in green, the technology ETF, the XLV, the healthcare ETF in yellow, the XLI, the industrial ETF in blue, and then lastly, the XLP for consumer defensives, staples in white. As you can see, the XME, as I told you before, ahead of time, will outperform the general market. Why? You go down to the bullet stocks, the sources. When it comes to inflation, you don't buy the companies involved in the war. You buy the companies, the stock of the companies that produces and manufactures the bullets for those engaged in the war. These happen to be in the materials sector of the market. And by the way, if gold wasn't included in the XME, materials would have been outperforming the market significantly. Unfortunately, the weakness in gold continues to drag on the XME. Now look at the performance of these different market sectors in September. Every sector of the market that I'm showing you right now is curling down. The only sector of the market curling up higher and gaining momentum is the XME, the materials sector of the market. And therefore, I continue to be overweight in materials. Matter of fact, the majority of stocks in my portfolio, the highest weighting is in the materials sector. Whether we're talking about NTR, Nutrin, or Alcoa, the steel ETF, Freeport McMoran, FCX, copper, I own a lot of names in the materials sector of the market, and I believe that materials will continue to outperform even after tapering. And the reason is we have legitimate shortages here, and the wage inflation story will not be over by tapering a little bit here and there in bond and mortgage-backed securities assets purchasing. You will find out that even after tapering, commodity prices will continue to go higher, including materials. The ultimate killer will be raising interest rates. And my belief is, now that the Fed is already late to tapering, they will have to face raising interest rates at some point. But until that point comes, I believe that materials will continue to outperform, whether it is aluminum, steel, copper, or even the agricultural fertilizer kind of stocks. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar for this week? A lot. Starting on Monday, we have the federal budget. We don't have a budget deal yet. They're still stuck in no deal, but we will see what the headline number is. Then on Tuesday, we have the small business index, and perhaps the most important reading, the most important number is the consumer price index, the CPI, also known as the CPI. And boy, the cooks will be extremely busy, extremely busier than ever before, because this is the last chance to rescue the market. You give us a weak number of the CPI, that puts tapering on hold. It starts to throw a little doubt in the market, the assumption that inflation is getting out of control and the Fed will have to taper. And there you go, the market bottoms, it rebounds higher, and here we go again. So the cooks have a job to do here by showing us weak CPI, a weak CPI reading. And they have a lot of help from Delta, by the way, because Delta crushed airfare prices, lodging prices, car rental prices. So a lot of these prices tied to traveling and the reopening of the economy, which we assumed to begin with, will be transitory. The problem is, as you might have seen already in the PPI, food prices are skyrocketing, surging higher. On top of that, we have natural gas and energy prices continue to surge higher. Likewise, how will shelter inflation? Remember the sleeping giant? Rents, that's rising higher, significantly higher. We're going to talk about the CPI in details in tomorrow's video. We're going to look at every single category and what the expectations are for every single category, and we will come up with a consensus whether the number should be weak or strong. Wednesday, we have the import price index, the Empire State Index, and industrial production. These are all important regarding the outlook for inflation. And then on Thursday, we have the initial jobless claims, per usual, the weekly ones. On top of that, we have retail sales and the Philly Manufacturing Index. And I believe that Thursday will be Yom Kippur, the Jewish holiday, so this will impact trading. Perhaps a lower volume on Thursday, we'll see. And then on Friday, lastly, September 17th, options expiration, the most important event. And then we have the University of Michigan Consumer Sentiment Index. A critical week, highly important. And if you thought it was interesting before, it will get even more interesting this upcoming week. Buckle up your seatbelts, put your diapers on, and let's go. Folks, this is all I got for you for now, but I will talk to you again soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.